There's nothing pundits love more than comparing the ups and downs of the housing market to a roller coaster, with good reason.
Auctions are in a downward cycle, pushing property prices lower.
Auctions beat reserve as buyers make a comeback.
Real estate agents turn desperate across Australia.
10 tips to help you make the best choice when buying a roller coaster.
And things are about to get even more rollercoastery. A Freedom of Information deep dive revealing Reserve Bank modelling of a 20% drop in house prices over the next 2 years.
That's a bit of a worst case scenario. It really depends on a few factors: global economic performance, our domestic performance, and really how long inflation sticks around.
Those steep interest rate rises and plummeting property values could see hundreds of billions of dollars wiped from household wealth. And that pessimistic outlook could drive prices down even further.
We are seeing the results of dealing with inflation and rising interest rates, and that's having an impact on the housing industry.
And this downward trend is prompting wildly different reactions. Some sellers eager to compromise, hoping to get their sale locked in before the rate rises scare off potential buyers. But others are sitting tight until things level off. The only thing certain in the market is the uncertainty.
It's not always worth trying to time the purchase of a property around whether the market is rising or falling, because you're going to find there are pros and cons to buying at any point in the cycle.
So can buyers and sellers do anything to survive these market fluctuations? Or should we just accept we're in for a wild ride?
And economics journalist Shane Wright joins us now. Shane, 20% is pretty significant.
Yeah, you wouldn't have seen anything quite that size since Collingwood got thrashed by Richmond in the 1980 grand final, and that's a sad day for fans of Stan Magro. But
I don't know what any of that means, but
Let me take you through.
Waleed will get you, and Pete and Waleed will get you up to speed on that
I'm
one.
good.
But
I think we can move on from the whole topic, to be honest.
yeah, it was a bad day, wasn't it, Pete?
It certainly was.
It's a long time since we would have seen that sort of correction. We've seen, through the last 10 years, we've seen a couple of falls, particularly in Sydney and Melbourne, but nothing that would approach 20%. But remember, the Reserve Bank thinks 11% is roughly where it'll get to, but they're starting to get a little bit anxious.
Gee, KB was good, wasn't he? He was so good that day.
He was.
Let's sit up straight, shall we? This is very serious, though, for a lot of people, because if you saw that kind of drop-off in house prices, anything like it, there will be a big chunk of people who, suddenly they can't afford their mortgages because house prices have gone up, and they can't repay their mortgages because the value of their house has fallen. And so they just go to the wall. Do you have any idea how big that cohort would be?
Well, no, in this case, I think you'd see people stay put. One thing, they can't afford to move. And we're not like the US where people can just leave the keys and just walk out, which is what happened through the global financial crisis. In Australia, if we see big falls in house values, normally you'd see people stay. And Australians, they love their Hills Hoist, their Pavlovas, Lamingtons, and paying the mortgage. And in this case, they would bunker down and do whatever they could, even say through 1990-91 recession when official interest rates were at 17%. Yep, there was an increase in the people who couldn't repay their mortgage, but so many people did hang on. And that's what I think you would see.
I take that point. It's different, though, isn't it, when the house prices are so much higher than they were back then? Yes, they want to pay their mortgages, but wouldn't there be a big portion of people who just simply can't, no matter how? And then what happens to them?
Well, in that case, you'd actually see the unemployment rate really climbing, and unemployment makes it very difficult for people to keep paying their mortgages. And to put it into some perspective, say in Sydney, the median house price went up 30% during COVID. If it drops by 20%, people are still, housing is still not cheap in this country. You go to, say, Brisbane or Adelaide, house prices there went up about 40%, the same in Hobart. So they would still be sitting on a substantial capital gain. The hardest hit will be those who bought in, say, the last 6 or 7 months, right at the top. And if interest rates go up too high and start hitting the jobs market, they will be the people who'll be really struggling.
It's a pretty bleak picture you're painting there, Shane. Is this good news for anyone at all?
I think I was talking to some prospective first-home buyers who were pretty happy about this because they have been absolutely crunched by what's gone on over the last 2 years. all the money that's flooded into the property market, and it's been transferred from those people who are selling, mostly at the higher end, getting a very large lump sum from people who were just getting into the market. And it's just, you can see the collapse in the number of first home buyers over the last 12 months. They are the ones who benefit most from a fall in house prices.
Right, Shane, always good to unpack it with you. Thanks for your time.
Always a pleasure, guys.